Hi everyone, in the previous video we started looking at cash flow from operations and we are going to continue our analysis. As always, we started with net income, added depreciation, added the loss back from PP&E sale because that's going to show up under cash flow from investing, and we subtracted any gain from a land sale. That's also going to show under investing. Now it's time for us to look at the current assets and current liabilities. In order to do that, we are going to start with accounts receivable. The accounts receivable has the gross figure here and allowance for doubtful accounts. What I'm going to do is I'm going to calculate net accounts receivable. That's the easiest way to track how net accounts receivable is performing. So in year 2022, net accounts receivable was $37,000, and in year 23, net accounts receivable decreased to $33,000. So that's a decrease in accounts receivable. Any decrease in the accounts receivable is going to increase our cash, as I mentioned in the introductory video. An increase will decrease cash, a decrease in current assets will increase cash. In this case, the decrease is $4,000, and as a result, add decrease in accounts receivable. I'm going to add that to cash flow from operations. Next, what I have is merchandise inventory. What we are seeing here is actually an increase from $25,000 to $43,000. So there is an increase in merchandise inventory. That's going to decrease our cash flow from operations, and I'm going to record that as such. And if you are not sure why we are adding decreases in current assets and subtracting increases in current assets, I highly recommend watching the previous videos where I showed actually why those are happening. So subtract increase in inventory. That's going to be in the amount of $18,000. Similarly, we are going to have an increase in prepaid expenses in the amount of $3,000. That's what I'm going to record as well. So subtract increase in prepaid expenses. Prepaid expenses are also current assets, so I'm going to, any increase is going to decrease our cash. Now it's time for us to look at current liabilities. Accounts payable is increasing from $23,000 to $31,000, so that's an increase of $8,000. Any increase in liabilities, current liabilities, is going to increase our cash just because we are not paying and we are starting with net income. So $8,000, add increase in accounts payable. We are going to add this. And then we are going to review salaries payable. Salaries payable also increased by $7,000. That means that's something we haven't paid, and it's going to increase our cash. Since we are not paying, it's going to increase our cash. So that's $7,000. Add increase in wages payable or salaries payable. And we are going to add this as well. Then we have interest payable. That's typically a current liability as well. In this case, interest payable is decreasing, so we are going to take that out. Subtract decrease in interest payable, and we are going to record that as such. Last piece is income taxes payable. That's also part of current liabilities. Taxes payable increased by $4,000. That means something we haven't paid. Add increase in taxes payable. Any increases in current liabilities, as I mentioned earlier, is going to increase our cash. Now we can calculate cash flow from operations, which is going to be the sum of all these. We are starting with net income, adding depreciation, adjusting any loss or gain from long-term assets, and adjusting it for current assets and current liabilities. That's going to give us cash flow from operations. In the next video, I'm going to show you cash flow from investing and cash flow from financing.